Welcome to the deep dive. Today we're really plunging headfirst into a book that it felt almost like a rebellion when it first appeared, especially considering the year.
Yeah, which one is that?
Mohnish Pabrai's The Dhandho Investor. We've gone through a lot of analysis on this text. It was published around 2007.
Oh, right, 2007, just before everything went sideways.
Exactly, just as the financial world was about to, hit the fan. So our mission here is to pull out the most important nuggets for you.
That year, 2007, it really was something else. You had markets just swimming in complexity, leverage. What did the central bankers call it? Excessive risk-taking.
Mm-hmm.
It felt like the smarter you were, the more opaque your financial instruments had to be. And everyone just sort of equated high returns with high risk. Frankly, it led to a lot of, reckless speculation.
Totally. And there was this hubris, right?
Wow.
This overcomplication. And Pabrai basically looked at all that and said, hang on, you're doing this all wrong.
He really did.
His core idea, which felt almost, heretical back then, was you can actually generate exceptional investment returns with low risk.
And he boiled that whole countercultural idea down to one phrase. It's incredibly sticky, a mental model that's just the absolute core of his book and what we're diving into today.
Which is?
Heads I win, tails I don't lose much. Everything, absolutely everything he talks about feeds back into that simple, really powerful concept.
Okay, let's unpack that then. Because for that whole Dhandho philosophy to even make sense, you've got to start with a pretty fundamental belief about markets, right? How they actually work. What's that bedrock idea?
Well, you have to sort of let go of the efficient market hypothesis, at least as a perfect truth.
Mm-hmm.
Pabrai's approach is really built on the idea that markets are not perfectly efficient. They regularly, sometimes, dramatically misprice simple, understandable businesses.
And when do they tend to misprice them the most?
Often when there's some kind of distress or maybe just high uncertainty swirling around the business or its industry. These situations, they scare off most investors, right?
Yeah, naturally.
So the price drops, sometimes way below the underlying value.
Yeah.
And Pabrai sees these moments, fear, neglect, misunderstanding, not as threats, but actually as the source of opportunity. His whole framework, things like investing in distressed businesses or focusing on low risk but high uncertainty situations, it explicitly relies on the market getting things wrong sometimes.
Which implies then that you, the individual investor, if you're patient enough and rational, you can actually spot these mispricings and take advantage.
Precisely. There's a strong belief there in the power of independent thinking. If you've got a clear, disciplined framework and you can control your emotions, you can identify situations where the price is just nowhere near the intrinsic value.
And Pabrai suggests the market usually figures it out eventually.
Yeah. He reckons they typically correct these mispricings over a reasonable time frame, maybe, say, 18 months to 3 years. That's where patience becomes absolutely crucial. You have to be willing to wait for the market price to catch up to the value you've identified.
It sounds like classic value investing at its heart, like Benjamin Graham stuff.
Oh, absolutely. It's rooted in Graham's idea that a business has a true intrinsic value, and that's distinct from its daily, often wild, stock price fluctuations.
Okay, so the beliefs are markets aren't perfect, real value exists, and you can find it if you're disciplined. How does Pabrai give you the actual toolkit, though, the sort of mental operating system to do this in practice?
He essentially gives you this mental framework, right?
Yeah.
Built on core principles. But the absolute foundation, the first pillar everything rests on, is that mantra we started with.
Heads I win, tails I don't lose much.
That's pillar one. It's just this relentless pursuit of asymmetric risk reward. Instead of accepting the conventional wisdom that higher potential returns must mean proportionally higher risk.
They flips it.
Exactly. Pabrai, like Buffett and Munger, he flicks it right on its head.
So the goal isn't finding high risk for high reward. It's finding low risk, but for potentially very high reward.
Yes. And that low risk part is key. It has to be clearly understood, quantifiable, and, importantly, survivable for you. The main goal isn't actually maximizing the win. It's minimizing the loss if things go wrong.
Right.
Think about that weighted coin analogy he uses. You win 10 pounds on heads, but you only lose 1 pound on tails. The Dhandho investor is trying to structurally engineer their decisions to get those kinds of lopsided odds in their favor.
All right, so that mantra is the bedrock, pillar one. What's the second pillar then? How do you actually find those lopsided bets out in the wild?
Okay, pillar 2 is the Dhandho framework itself. The set of principles that kind of guide where and how you look for these opportunities.
The how-to guide.
Yeah. Pabrai lists, I think, his 9 key principles in the book. Things like Focus on existing businesses, simple ones, look for durable moats, make few bets, big bets, but infrequently.
Yeah.
That kind of thing. But there are really 3 mental models within that framework that are just critical for actually implementing the heads I win, tails I don't lose much idea.
Let's hear them. First one, maybe the most famous, margin of safety.
Absolutely non-negotiable. This is pure Graham. It's buying something for significantly less than your conservative estimate of its intrinsic value. Pabrai sees it as your buffer, your shock absorber, against basically everything that can go wrong.
Unexpected downturns, company-specific problems.
Or just being wrong in your analysis, it happens.
So it's the reason why tails I don't lose much is even possible. It's the cushion.
Precisely. Think about it. If you pay $1 for exactly $1's worth of value, any little wobble means you lose money,
Yeah.
right? But if you pay 50 cents for that same dollar's worth of value, well, now you've got a lot more room for error before you experience, significant permanent capital loss.
Makes sense. Then there's this real focus on simplicity. And staying within your circle of competence, Pabrai seems to love painfully simple businesses with painfully simple theses.
He does. And he actively avoids complex ones because, as he puts it, they obscure risks. Complexity is basically the enemy of understanding your downside.
Right.
If you can't explain, really simply how a business makes money, what its real risks are, and why you think it's cheap, you probably don't understand it well enough to bet on it safely.
And that ties into the circle of competence idea.
Exactly. That's Buffett and Munger, right? Stick to industries and business models you genuinely deeply understand. It protects you from those really dangerous unknown unknowns.
He has that brilliant rule of thumb, doesn't he? You should be able to explain your investment thesis to a 10-year-old.
Yes. And if you need Excel to make the case.
It's an automatic pass. I love that. It just cuts through so much noise.
It really does. But, thinking about today's economy, isn't a lot of the value now in complex stuff like intangible things, software, brands, network effects? Does that painfully simple rule still apply quite so easily?
That's a really good point. I mean, Pabrai himself, in the book, he definitely leans towards more traditional, maybe slower changing industries.
Right.
And yeah, valuing, say, a fast-growing tech company with mostly intangible assets is, well, it's a different kind of challenge than valuing a motel or a manufacturing plant.
For sure.
So maybe the challenge today is applying that principle of deep understanding, even if the business itself is more complex. Or maybe just acknowledging that some areas, they just won't fit neatly into that classic Dhandho simplicity box.
That's a good distinction. Okay, so the third key mental model in the framework, and this one's maybe the most counterintuitive for a lot of people, it's investing in low-risk, high-uncertainty businesses.
Okay, hang on. Low risk and high uncertainty. I mean, to most people, uncertainty feels like risk.
Right.
How does Pabrai pull those two apart?
Yeah, this is where he really challenges conventional thinking. He argues that the market often confuses temporary, headline-driven uncertainty with fundamental permanent risk of capital loss. So a business might be facing scary headlines, maybe a regulatory challenge, or some temporary operational hiccup. This creates huge uncertainty in the public mind, right? And the stock price tanks.
Panic selling kicks in.
Exactly. But, and this is the key, if the underlying business still has solid assets, maybe manageable debt, a strong market position, or, resilient demand for its product, the actual risk of that business going to zero, the risk of permanent capital loss, might actually be quite low, despite all the noise and uncertainty.
Ah, I see.
So the high uncertainty scares away the impatient money, creating a situation where you can potentially buy real assets, real cash flow, for far less than $1, as he says. The skill, of course, is telling the difference between a temporary storm that a sound ship can weather.
And a ship that's actually sinking.
Right. That's the hard part. But the uncertainty itself creates the depressed price. And if the underlying fundamentals are solid, that's where the low-risk potential comes from. It takes courage and obviously analytical rigor to look past those scary headlines.
So the market skepticism driven by uncertainty is actually the Dhandho investor's friend, because it creates the mispricing.
Precisely. So pillar 2, the framework, it's basically this set of filters and principles, margin of safety, simplicity, targeting low risk, high uncertainty, all designed to help you find these asymmetric opportunities.
Got it. Okay, and that brings us to pillar 3, which isn't about the market or the business, but about the investor themselves. The psychological armor, you called it.
Yeah, exactly.
Yeah.
Because success in Dhandho, maybe more than any other investment style, it really relies heavily on temperament. It's as much about behavioral control as it is about analytical skill.
How so?
Well, Pabrai stresses patience and extreme patience, staying rational when the market is going nuts, either euphoric or terrified. He's famous for saying, if one is not willing to watch paint dry, then public market investing may not be the right path.
Watching paint dry, yeah, that really captures the waiting, doesn't it? The stillness you need.
Yeah, it does. And he connects that patience directly back to having a simple, clear thesis and, crucially, that large margin of safety. If your thesis is strong and you know you bought cheap, you have the conviction to just sit tight when the price drops. Or maybe wait years for the value to finally be recognized by the market.
It's about fighting those basic human drives, isn't it? Fear and greed.
Absolutely.
Oh.
Overcoming them. It makes me think of that Stoic fisherman idea. You're not chasing every shadow in the water. You're waiting calmly for the right conditions, the right opportunity.
So this psychological armor, it's not about being emotionless.
No, not at all. It's more about informed, rational detachment.
Mm-hmm.
And that detachment comes from the conviction you build through your analysis, the simple thesis, the margin of safety. Knowing you've already minimized your downside up front, that heads I win, tails I don't lose much, framework, that's incredibly powerful here.
How does it help psychologically?
It helps you resist the urge to panic sell during downturns. Because you've already thought through the worst case and decided it's survivable. It builds that rational confidence you need to act counter-cyclically. To actually be greedy when others are fearful, as Buffett says.
Okay, so we've got the foundational beliefs, the framework for finding these asymmetric opportunities, and the psychological discipline you need. But let's be real, applying this in the real world, especially today, it must have its challenges, right? Where does this model maybe start to bend a bit?
Yeah, absolutely. And we touched on one already, the difficulty of applying it directly to those fast-evolving, tech-heavy industries, where the value is mostly intangible, and Pabrai's preferred copycat approach might just be too slow.
Right. The focus on slow change industries makes sense from a risk perspective, but it does potentially cut you off from a huge chunk of the modern economy.
Exactly. And another really critical point, I think, is the definition of low risk itself, especially when you look at the concentration aspect.
What do you mean?
Well, Pabrai uses examples like the Patel motel owners, pooling all their family money into just one or two motels, or even his own early ventures, using significant personal capital.
Okay. So while the business itself might have those Dhandho characteristics, simple, understandable, bought cheap, putting a huge percentage of your personal net worth into just one or two things, that feels like anything but low risk from a personal finance perspective, even if the business is solid.
That's the crucial nuance, isn't it? The low risk often refers to the probability of a permanent absolute loss for that specific business venture. But if that venture represents a massive concentrated bet relative to your total wealth, well, the personal financial risk is potentially extreme.
Right.
And Pabrai advocates few bets, big bets, which inherently means concentration. So don't lose much on that one bet. It could still be financially devastating to you if that bet was, 50% of your capital.
That's a really vital distinction to make. Okay, what about in markets that aren't obviously panicked or mispriced? Like during a long bull run, finding these genuinely undervalued, truly low-risk Dhandho opportunities must be incredibly hard.
Oh, it is. Definitely. It requires that extreme patience we talked about.
Yeah.
Often it means you'll be sitting on cash for extended periods.
Yeah.
And that can be psychologically really tough.
Yeah, watching everything else go up.
Exactly.
Yeah.
You might end up underperforming simpler index funds during those long stretches where, seemingly everything goes up.
Oh, well.
It seriously tests that pillar 3, the patience.
And then there's the classic risk for any value investor, the value trap.
Right.
Investing in distressed businesses is core to Dhandho, but how do you avoid mistaking a temporary problem for a permanent terminal decline, a business that's just not coming back?
This is where the skill really comes in, isn't it? The framework helps you look for the right characteristics. Strong balance sheet, durable moat, real assets, but it doesn't guarantee foresight. Telling the difference between a business facing temporary headwinds and one that's just on the road to obsolescence, that's difficult. It's a common pitfall.
So the model's powerful, but it's not foolproof.
Not a magic bullet, no. It definitely requires skill, context-specific application, and really acknowledging that low risk isn't the same as no risk, especially when personal concentration is involved.
Okay, let's try and wrap all this up then. The core beliefs, the framework, the psychology, and acknowledging the limits. What's the essential distillation of Dhandho? What's the absolute core?
At its heart, I'd say it's disciplined opportunism, but driven by a really profound aversion to permanent loss. It's about constantly, patiently scanning the world for heavily skewed odds. You do that by doing your homework, demanding a wide margin of safety, and always, always protecting your downside first.
Like those stories in the book.
Exactly. Think of the Patel motel owners, or the early entrepreneurial ventures of people like Richard Branson or Lakshmi Mittal that Pabrai discusses. They are Dhandho case studies. They weren't just buying stocks. They were acting like frugal, sharp business owners, making calculated risk-minimizing moves that happen to have tremendous upside potential. It's really about capital allocation, where minimizing risk is the absolute top priority.
Okay. So, if you could only take one single powerful mental tool away from this entire deep dive, implant it permanently in your decision-making process for everything, what should it be?
Oh, that question. It's the phrase itself.
Heads I win, tails I don't lose much.
It's just incredibly simple, right?
Yeah.
But it completely transforms how you evaluate opportunities. It forces you right at the start to ask the single most important question: what is the absolute maximum I can lose here? What's the permanent damage if everything goes totally wrong?
And crucially, is that maximum loss minimal, and is it truly survivable for me, personally?
Exactly that. You answer that question first, only if the answer is a clear, confident yes. Okay, the downside is minimal. I can quantify it. I can survive it.
Yeah.
Only then do you even bother looking at the potential upside.
And if the upside isn't huge compared to that tiny risk?
You walk away. Simple as that. If tails means you lose significantly in a way that really hurts you, it's just not a Dhandho bet. End of story.
That really flips your whole perspective, doesn't it? From chasing returns first to protecting your capital first, it must build resilience.
Totally. And it applies way beyond just the stock market. Think about it for career decisions, maybe starting a side hustle, making a major purchase, even negotiating something important.
How so?
By anchoring your decision in a really sober assessment of the worst-case scenario before you let yourself get carried away by the potential gains, you inject rationality. It helps combat overconfidence, FOMO, the fear of missing out.
Yeah, I can see that.
It's basically a philosophy for allocating any valuable resource you have, your money, sure, but also your time, your energy, even your reputation. It's about enabling those potential risk-free bets with tremendous upside, not just in finance, but really in navigating the inherent uncertainty of life itself.
So Mohnish Pabrai is the Dhandho investor. It offers this really powerful, quite contrarian framework for thinking about risk and opportunity, all wrapped up in that deceptively simple phrase. And while, applying it requires nuance, especially today, that core mental model, it feels like an enduring and profoundly valuable tool for anyone who thinks seriously about decisions.
Definitely. So maybe here's where it gets really interesting for you, the listener, where maybe outside of traditional investing, could applying this heads I win, tails I don't lose much framework actually change how you approach a big decision coming up in your own life? Something to think about.